All right. Okay. So, welcome to class 4, everybody. I think we are still missing quite a lot of people, so we just do a quick, um, you know, overview of what we're going to cover today. Um, so just now I mentioned, hope that you guys are already starting on your GBA because this time I think this module, the GBA, can be quite heavy. There's a lot to write. Of course, if you have any issues, feel free to reach out to me. At the same time, today, I think what we're doing is we're going to cover the lecture materials. If you notice, there is actually not too many slides compared to the last 3 lectures. So we'll use the remaining time to talk about the TMA. The results of the TMA will be released this weekend. I think it's just going through some administrative stuff, should be released. But we'll just go through the questions. Of course, you know your answers, right? So we can discuss, because at the end of the day, it's a case, so there are a lot of interpretations. So we can discuss on, whether you should answer it this way or that way, right? And yeah. So today, what we're doing is, remember for the last, so we are already more than halfway through, which is a good thing. We are on the 4th lecture. So for the first 3 lectures, I guess what we talk about, the first one is the IPS, which is more like a legal document, and we talk a lot about it. Then we moved on to more of the asset allocation on the 2nd lecture. All right. And then for the 3rd lecture, we talk about like market, right? Like we kind of go into detail more on like the economics, what kind of market factors that might affect your decision. So this time today, what we're doing is more on risk management and balancing. So when we understand risk management, right, there are a lot of various products that you can use to manage risk. At the same time, for rebalancing, there are various techniques used to rebalance your portfolio. So the question is, which one should you use? I guess at the end of the day, what we're trying to do, right, as a portfolio manager is that, first of all, you have to have a very wide scope of knowledge. If you realize by now that you need to know a lot of things, right? You need to know about trust, you need to know about risk willingness, risk ability, right? You need to know a lot of concepts. But at the same time, you might not need to go so in-depth in each concept, in the sense like, okay, let's talk about trust, like how do you actually create a trust and all the details, right? You might not need to do that. And that's quite reflective of industry as well, right? So if you are a portfolio manager, usually you can recommend a product and you need to know roughly what's the product, but you need not say structure the whole product, right? Structure meaning that you create the trust. Usually in the industry, what happens is that a specialist will be in charge of structuring the products for you, right? Basically, you recommend the products, the structurer will kind of like tell you, okay, I can structure these products, and then you can recommend these products to your client, and then as a portfolio manager, that's what you do, right? Then you recommend it to a client. So what you notice, even today, there are various techniques. There are a lot of techniques that will be introduced. But at the end of the day, which one is best depends on, first of all, the structurer and of course your recommendation. So you need to know those techniques. But in terms of the detail, of course, it's good to know the detail. But if you don't, then that's not too bad as well. As usual, if you have any questions, feel free to type in the group chat or just unmute yourself. All right. Okay. All right. Then let's just start this lecture. Okay. So today we're going to talk about 2 parts. So we already talked about risk management and then rebalancing. So let's tackle risk management first. When we think about risk, there are actually 3 key risks that we want to identify and tackle them. First, when we think about risk, we think about market risk. So market risk is generally linked to changes in the prices of your investment. So it can be stocks, it can be commodity, it can be bonds. And so this change in price could result in a change in supply and demand, or at the same time, your returns, right? For example, the bond, we know that bonds are inversely proportionate. Bond prices are inversely proportionate to the interest rates. All right. Then we have your credit risk. Credit risk is something that is also very important because with the the 2008 financial crisis, there are a lot of emphasis on how do you mitigate credit risk. And the problem with credit risk is that the chances of the event happening is usually quite low, right? Whether a company defaults. But when it does default, then the impact is very large. So that's the tricky part of mitigating credit risk. It's a low probability, high impact of event. All right. Market risk is more like a daily kind of like up and down and stuff. So that's how you try to manage the daily, weekly, or monthly increase and decrease, right? Last but not least, liquidity risk. We won't really talk so much about this. Basically, it's how liquid your product is, right? Because your liquidity risk is kind of linked to the type of investment products that you recommend. And I think when we talk about asset allocation, we went in detail with type of products, and of course, when we talk about type of security of products, they have their own intrinsic kind of liquidity risk in the market. All right. Any questions so far? No. So this is a quick overview. Now let's have a look. Okay, so when you think of market risk, the main measure of market risk, right, and we'll go very in-depth with this, is called this value at risk. So if anyone is working in a bank now, or maybe in the risk department in companies, this will not be a new concept, and perhaps you even know better than me on how they actually manage this value at risk in your company, right? So the intuition, like as usual, I like to give you like how do you think about things, right, in the most like layman kind of term, right, rather than the whole like very finance kind of like way of thinking. So in the layman terms, right, when you think about value at risk, it's basically what you're saying, right? So how much of your value of, let's say, your investment or whatever is at risk? And when you think about at risk, right, you may think of the minimum amount of money that you will lose, right, at risk. So for example, if you want to put it in a sentence, it's like you will lose at least, let's say, $1,000. So it can be 1,000, but it can be more than 1,000. But what is the minimum? So the at least part, or at risk part, it gives you like the minimum kind of idea, right? And it basically translates to the definition of value at risk. So when you think about risk, there's probability, and of course, there is the magnitude of loss, right? So in this idea, the value at risk would based on, first of all, the probability of something happening or a loss event happening, and at the same time, what is the minimum loss that you incur, all right, which is stated here. So everything that I've talked about is stated here. Of course, this one is expressed in a nice like finance way, right? Of course, when the probability of something happening is low, usually the magnitude is high. All right, so I would like to try to imagine or pull back your knowledge on statistics, right? When you think about normal distribution. So yeah, the idea will be important because we'll look at a bit of a normal distribution later, right? When you think about normal distribution, right? Let's see if I can just draw here. So when you think about normal distribution, you have your bell-shaped curve, and probably, yeah, you guys know about this. Basically, as you go towards the tail end, right? So imagine this is loss, right? So as you approach the tail end, your probability of, so area under the normal distribution gives you probability, right? So as you approach towards here, your probability of something happening is lower because your area under the graph is lower, but the loss amount, for example, the loss amount here is very high, right? Because in a standard normal distribution, here is 0, right? So if this part say loss, then your extreme end is high loss. So with this in mind, right, we kind of can understand, let's say if we do like a 5% so 5% VAR, or let's say VAR or value at risk, compared to a 1%, which one would have a larger loss amount? Anyone can just type it out or unmute yourself. So 1% versus 5%. So if you think about it, the 1% would be lesser, right? As in a higher loss, right? Because the 1% is a smaller probability. So what is the 1% chance that you lose or what's 1% VAR, or what's the 1% probability, or what's the 1% kind of magnitude that you'll lose, right? So that will be the bigger amount. So that's how you think about it. So later, of course, we'll go through a lot of details of this value at risk. The simplest way to understand it is always think about the normal distribution. So once you have the normal distribution in your mind, you can kind of understand the concept a bit more. It's not so like abstract. All right. Okay, let me just clear this. Oops. Okay, so we have talked about this minimum loss, potential. Yeah, okay, nothing much to talk about. Okay, so there are various techniques to assess your value at risk. One of the key techniques that we'll look at is this variance covariance method, and it's probably not something unknown to you, and this is called an analytical method. All right. So in this variance covariance method, you are assuming, first of all, again, we talk about a normal distribution. And the key aspect for this is we need to know the expected return. And remember, we already know how to calculate expected return is the probability or the weight times the return of individual assets, right? What's the expected return? We talk about that. And the standard deviation of the portfolio. And remember, when you think about standard deviation of portfolio, we need to think about the correlation, right? That is between the assets, which is why we have diversification. So we need to know how to calculate this, and we need to know how to calculate this, which is what we covered in chapter or lecture 2. Anyone can kind of remember what does this formula kind of reminds you of? If you remember your statistics, so this formula here. Anyone kind of remembers what's this? So everyone took statistics, right? Here. Okay, okay. So if you do recall statistics, this is kind of your confidence interval. Hope this is not new, right? Yeah, okay, so yeah, so this is confidence interval or CI. Remember what's your confidence interval? So confidence interval is what is the probability that a sample, let's say you have a 95% confidence interval, what's the probability of your sample when it's being picked will fall into that range of values, right? That's the meaning of confidence interval. So if you have 95% confidence interval, means that 95% of the chance your sample that you pick will fall into the range of values. All right. So hopefully you can still recall what is that, and if you need to try to brush up a bit on your statistics from probably year 1. But what this shows, right, is your confidence interval, because confidence interval is your expected value, all right? So in this sense, expected return minus your z-score. And how you get your z-score, because you're using normal distribution, I've wrote it here. You can use Excel, right? Your z-score, and your z-score is based on what is the what's the probability that you want. So by 5%, 1%. So remember how to calculate z-score, right? Use this formula in Excel, and the percentage here can be anything. It can be 8%, but usually people use 5%, 1%, or 0.1%. Yeah. So, or 10% sometimes even. So again, your confidence interval is your expected value minus your z-score minus your standard deviation. But in the sense of a VAR, because we are looking at only the negative side, we're lost, right? So that's why there's a negative here, right? In terms of if it's a negative here as well, right? If it's a confidence interval, if you recall, it's usually expected return plus minus z-score times standard deviation, right? So what is it trying to say here? Let me just quickly draw the normal distribution so that you can kind of understand conceptually what's happening, right? Rather than just memorizing this formula. So your expected return let's just say is here, right? Maybe let's say it's 100. All right. So this is expected return. And let's say you have a 5% probability, right? So, and this in terms is a loss event. So let's use the right notation to put it here. So this is 5%, right? And because we are interested, because it's a, remember your confidence interval is a plus minus, but this one is a minus. So you're looking at the left side of the curve. All right. So this part is 5%. So you're actually trying to see what is the chances of your loss and what's the magnitude of your loss at this 5% region here. All right. So this is your the VAR that is being calculated. And of course, why you times the portfolio value is because your VAR is in terms of magnitude, right? So how much of a portfolio you lost? So you just multiply by the portfolio value. Okay, I repeat again, for this z-score, it can be anything based on the question. So how you calculate a z-score, use your Excel to calculate, use a normal standard distribution. So a normal standard means that instead of 100 here, if you notice, we are going to shift everything to 0, right? So this is, again, your year 1 statistics. So basically what we are trying to do here by using a normal distribution, and a normal standard distribution is that we are going to shift everything to 0. And so when we do a shift, everything will move to let's say, okay, I move to shift to 0, right? So you shift it here. So everything will just shift, right? And because normal distribution is symmetrical, the properties are very nice. So we can just shift here and there anywhere we want, right? Of course, you just need to make sure that you multiply and do everything properly. On the, now we're talking about normal distribution. And probably we'll discuss more later, but anyone knows like what are some drawbacks, right, by using this covariance method and assuming a normal distribution? Anyone can just think of some drawbacks of using this? Yeah, okay. Thanks. Yeah, your data could be inaccurate. That's right. Maybe because all this data is historical, right? So it can be inaccurate, right? Your historical data might not reflect what's happening now. Maybe to add to that, it could be also that maybe your data or your kind of distribution shouldn't be normal. Yeah, may not be normal. That's right. It shouldn't be normal or may not be normal, right? Of course, at the same time, since you're only doing the tail end, you could under or overestimate the tail end. So what it means is that because your normal distribution, you know that it can be very thin like this, all right? Or it can be, the tail can be very thick, right? So depending on how thick and thin, your area would change. So this would affect your kind of result. And not to go too detail, but I believe your stats professor will have told you this, right? Whether how thick or thin there is a third order differentiation of your normal distribution, right? So you have your skewness and your kurtosis. So kurtosis, hope this is not new. So kurtosis is basically how thick or thin your tail is, right? Your fat tail or thin tail. So because of that, this could actually affect your results as well, right? So all this, just in case in your finals, I think GBA, but in your finals, if they ask you about this, what are some like benefits or what are some drawbacks of assuming a normal distribution? Hopefully you can answer it, right? Okay, so this formula again, I repeat, is very important. We'll please highlight it and we'll look at example using this formula. Okay, so there are some, I already mentioned this, the magnitude error, yeah, might not be symmetrical. So what does this mean? The option return might not be symmetrical. So later we'll talk about options. swaps and stuff. Some of you I know have already taken the derivative module, so this will be like a repetition. But for most of you, I think you all have not taken it, so it will be something new. Yeah, so in the options, your returns are not symmetrical, unlike forward. So forward is a kind of instrument. So a forward is kind of symmetrical like a stock, but options are not. So we'll see how will that impact. Maybe not here, but what I want to highlight is also, any of you all have taken a bond course on bonds? So yeah, so like fixed income instrument, they call it fixed income instrument, bonds. Anyone have taken it, or no one have taken like a course purely on bonds? Okay. So if you have not taken a course on bonds, have you heard of this thing called duration measure and convexity of a bond? Duration and convexity. Or this is like totally new to everybody. What's duration and convexity? No, so it's no one knows what's that. Okay, so why I'm talking about this is because remember your bond yield curve. Okay, your yield curve. Typically, your yield curve for a bond is upward sloping like this. So, as you know, when a bond is in its process of maturity, when it's alive, the bond is alive, the risk of the bond changes over time. So it's unlike, or actually it's very similar to stocks, but because stocks will go up and down in the market, right? But in a bond, it doesn't like go up and down because there's no like market to track like the price of the bond, right? But naturally, in like based on your intuition, you know that the risk of the bond should change, right? And when I say about this thing called convexity and duration, it means that, you know what, we are trying to measure the risk of the bond, and the risk of the bond changes over time due to interest rate. So the duration kind of changes the risk of the bond, and the convexity changes the also the risk of the bond, but more at the tail end. So let's do this. Should I use this color? So the blue curve is more of the duration measure, which shows how the risk of the bond change, and the convexity of the bond basically shows the tilting of, or the increase of the risk as the bond proceeds to its maturity. And at the start, as you can see, there's a bit of difference here. So this is the convexity, how convex the bond is, right? So for example, not all bonds are in this shape. Some bonds could be, the yield curve of the bond could be like this, like very steep. So when it's so steep, your convexity, right, will be a lot, right? So let me just quickly draw the convexity of the bond for you. Okay, this is so bad. Okay, let me see. All right, so for example, like this, and then your convexity here is so much bigger, right? Imagine it's very big. So basically, what am I trying to say? In your study guide, right? If you read through a study guide, they talk about this duration and stuff, right? And if none of you have taken a bond course, you're like, oh, what's the duration? Duration, is it time? Is it what? Yes, it's time, but basically it measures the risk of the bond. So and the risk of a bond is measured on the yield curve of this bond. And so because of this idea of convexity and duration, what happens is that if you use this covariance or variance covariance method, you are not able to mimic the changes in the bond yield, because the bond might not follow a normal distribution, basically. That's what I'm trying to say. So very similar to this issue of options, right? Options are asymmetrical. So in a bond, it's the same thing. All right. Okay. Any questions regarding this on the topic that we just discussed a bit on bonds? So again, I'd like to highlight that most of the time when we do this, this kind of like introduction of topics, right, you'll notice that it's not very in-depth. Like if you take a full bond course, you go in very in-depth on how you price the bond and all this. But the idea of portfolio management is that you need to know a lot of everything. And you should be able to talk about a lot of things, but you need not go too deep. And probably you already saw that in your TMA, and now when you're doing your GBA, you notice as well. All right. Okay, so let's just look at this. This is a very informal question. There is a more formal one in a bit, but we have 10,000, and then you have two options: losing money 1 year out of every 3 years, or losing at least 1,000 out of every 10 years, right? So 1 out of 10, 1 out of 3. So this allows us to find what is the probability, right? So we know the probability is this. And if you assume a normal distribution, and then you know that 1 out of 10 is 10%, and 10% is this, right? So if you know that the expected return is this and the standard deviation is this, naturally you realize that, hey, you know what? The second option would result in a higher, or not higher, but like the VAR would be much, because of this, right? The VAR would be much smaller, right? Compared to this. Because remember the formula for VAR, it's, let me just quickly go back. It's this, right? Z-score minus the standard deviation. So imagine everything's the same, but your Z-score is different, right? So a larger Z-score will result in a smaller value here, and because of smaller value, your VAR will be smaller, right? So that's how you can think about it. But let's look in a formal example, because that one is just more for intuition. So for example, we have this question here, and then analysts would like to know the VAR of portfolio consisting of 2 assets, a long-term bond in the US and a long-term bond in UK, right? So they have expected monthly. So this is important why I highlight, because you need to make sure that are we talking about months, are we talking about weeks? So let's this one is monthly return. The bond is this, standard deviation is this, and then for UK bond is this and this. All right, correlation, because when we talk about portfolio, remember when we calculate standard deviation, we need to consider the correlation. So correlation is this, and portfolio value is this. All right, and it's equally weighted for the 2 assets. So the question is asked, use an analytical or covariance or variance covariance method to calculate the 5% monthly and weekly. So there's 2. So you need to calculate 5% monthly first, then you calculate 5% weekly. So you do it separately. All right. Okay. So first of all, let's calculate the expected return of the portfolio. And so, expected return is very simple. Probably after the TMA, you should have known how to do this, because most of you all did it pretty well. All right. Now, for portfolio variance, remember the formula that I've went through in the lecture 2A's recording. So we need to minus 2 times the standard, 2 times the weight times the standard deviation and times the correlation here. All right. So we get the monthly variance of the portfolio. Of course, remember, variance is not the measure of total risk. The total risk is measured using standard deviation. So basically, you just square it, or square root it. Square root it. So you get this. All right. So once we have all the values, standard deviation of portfolio, and the expected returns, what we can do is we just plug it into the VAR formula. So this expected returns, and then we plug it. So it's 5%. So where you get the 1.65, so go to Excel, use the norm standard function, right? So normal standard distribution function, plug in 5%. You should, okay, so remember, if you do it now in your computer, if you're Excel, right, if you put in the formula, it should give you a negative 1.65, if you notice. All right. So remember, the standard normal distribution is symmetrical around its around the mean, right? So what happens here is most likely when you plug in your answer, you will get a negative value. And the thing is, because normal distribution is symmetrical, so the negative 1.65 is here, is symmetrical to 1.65. All right. So if you have Excel, try to use that formula and see what it means, right? So you get a negative value, but it's basically symmetrical. And so you just assume this and plug it into the formula here. And then you multiply by the standard deviation. All right. So this is something very important. Always use a positive value here because your here is very negative, right? So use the positive output in the Excel. So don't use the negative output because the idea is symmetrical. And what you're interested in is because this formula is interested in this part here, but the formula already included the negative. All right. So this is very important. If you put it as a negative, right? So negative times negative become positive, and then your whole answer is wrong, right? So please take note about this. Okay, and then you multiply by the portfolio value, you get your monthly VAR here. All right, now you can calculate your weekly value as well. So what you do is you best prorate, right? So you know 1 year has 52 weeks. And then you times 12 divided by 52. So I think some people might say, oh, can I just divide this by 4, right? Can I just divide it because monthly, right? So weekly just divide by 4. You can. This way of doing it is just more accurate, right? And given that I think the study guide and the textbook use this method, so please use this method in your exams or GPA as well, right? So times 12 divided by 52. To convert from month to week. All right. Do the same thing for your standard deviation, but please take note that we cannot immediately. You should not multiply this with the 12 divided by 52. So you should not do that. You should work with the variation. So use this value here. Times 12 divided by 52, then you square root it, okay? So please take note, do not use the directly a standard deviation because if you do that, then your scaling factor here will be wrong because if you square root it, that means you need to square root this as well, okay? So please work with the variance, then, so use the variance multiplied by the proration, then after that, you square root it, okay? This is important. All right. So once you're able to get these two values, basically it's the same thing. You just plug it in and you get your VAR for a weekly VAR. So what's important to take note is that you shouldn't compare monthly VAR with weekly VAR. There's no such thing. You cannot say, oh, 5% monthly VAR for portfolio A is more than the 5% for weekly VAR for portfolio B. You can't do that, okay? You need to compare VAR of the same period. So if it's monthly, you must compare monthly with monthly. All right, this is important because, of course, your monthly will be higher than your weekly, right? So if you compare monthly to weekly, it's not correct. Any questions for this? So this is a very typical kind of question, something that you really need to understand how to calculate. Everyone's good with the calculations? Yeah. Okay. All right. So if everyone's good, then let's move on to the next historical method. So historical method basically says that, we just see what's happening in the past, right? And from there, then we come up with the whether we have 5% or 1% probability, then we try to observe for 1%. Okay, so if you have 1,000 observation for 1%, means that it's the 10th observation of the worst loss. If it's 5%, then it's the 50th worst loss situation. So we have an example later to illustrate this, but basically what we're doing is just, we know what's the historical, the whole long chain of historical, and then we just do 1% and 5%, right? Or it can be any percentage. And we just look at, based on the number of observations, if it's a 1%, what is the observation that we should look at? So the good thing about the historical method is being non-parametric. So the idea of non-parametric means that you do not need to assume a normal distribution. You just let the historical value dictate what kind of distribution it is. And we are not bothered by it, but we're just looking at the worst case, let's say the 10th worst case scenario in the 1% for 1,000 observations. Of course, as usual, if it's historical, the distribution might not persist. In the past, for example, because of COVID, things might change a lot. And again, for bonds and derivatives, they behave very differently. We talk about, remember, your duration, your convexity for your bonds, and for derivative, your options are asymmetrical. All right. So you have this Monte Carlo simulation method. We mentioned a little about this, I think, in lecture 1. Basically, they use the idea of historical method, but the only difference or the only nice thing about this Monte Carlo simulation is that we kind of simulate multiple times of the historical data. So we use the historical data, do a simulation, but we repeat the simulation, let's say 10,000 times, and then we take an average of the 10,000. Basically, what we're trying to do is that we will play with the probabilities, right? And the certain values, certain changes in the values. And from there, we take an average. And because of that, we are able to simulate a more accurate kind of market reaction, the market behavior, right? Because we are doing simulation and we're doing multiple times. As you know that when we do averages, they are generally better as they converge towards the real value that we want to estimate. All right, so this is the Monte Carlo simulation. Okay. So there's this example here. So basically, they're using a historical method and a Monte Carlo simulation. You consider 10 million portfolio of stocks, and then you simulate this portfolio, and the simulation, you're assuming a normal distribution. So remember, the Monte Carlo is a type of method. The historical method is like, basically you can use historical data or like forward-looking data, right? So for this question, you're combining both the Monte Carlo and the historical method. And in the Monte Carlo, you have to kind of assume a kind of distribution, right? So this one, you need to assume they are assuming a normal distribution of return, expected return of this, standard deviation of this, and you generate 700 random outcomes, right? So those of you who have taken like the derivative mod or even the more of like the, I'm not sure why they call it here there, but I'm not sure why they call it SUSS, but basically the mod that teaches you how to do simulation. You might already know how to do this Monte Carlo simulation. It's not too difficult. You can do it on Excel as well. All right. So what you do is you generate 700, and then below here is the 40 worst outcome, right? And now they ask you to compute the 5% and 1% annual VAR. So how do you do this? Actually, once you understand the concept, it's not too difficult. So 700 outcomes in a 5%, basically you take 5% times 700 means the 35th worst outcome, all right? And so you basically just go back to this table here, you count, and it's quite nicely put for you, right? In like a decreasing function. So you count 35 on the 35th worst return, and you get this value here, negative 0.22. You just multiply it by the value here, all right? By the portfolio value, and then you should get the answer. Similarly, for 1% VAR, so what you just 1% multiplied by 700, remember the total number of outcomes, you give you a seventh worst return, and you go back into the list of outcomes, and then you just find where is the 7. Sorry, this one should have a 3 here as well, I think. Let me just see. Yeah, it should be 23, 0.223. So it should be 23 here. There's a 3. All right. Any questions? I mean, I'll just pause for a short while. Any questions on this example. All good? Yeah. Okay. All right. Then I'll just move on. Also, so some limitations of using the VAR method is that sometimes remember we talked about the normal distribution. We can actually underestimate the magnitude and frequency of the worst case scenario. And how I explain this is due to the kurtosis, right? Of how thick your tail is, whether thin tail or thick tail, right? So this will affect your VAR calculation. Because if you notice, even for a Monte Carlo simulation, you're assuming a normal distribution. And it's quite common to assume a normal distribution, but it shouldn't be the default, right? Sometimes it can be, okay, so for example, if a question ever asks you, oh, maybe what are some disadvantages, right? Then you say, oh, it's a normal distribution. Yeah, that's good, but maybe you can suggest another distribution. So there can be an exponential distribution, or maybe it can be a binomial distribution, or a Poisson distribution. So I hope you do remember all these concepts, right? What's a Poisson, what's a binomial? Obviously, you don't need to know how to calculate it, but what I'm trying to say is that you need a big breadth of knowledge. So you need to remember a lot of things, but you don't need to go to the details. So you need to say, oh, maybe you can suggest exponential and give a reason why you suggest exponential distribution. Or maybe actually more a binomial, so you can say that, right? And then, of course, what you can do is you backtesting. Backtesting means that you use the historical data to test your simulation, test your model, whether it holds true for the simulation, for the past. So if the model holds for the past, your underlying assumption is that this model will hold true for the future. Of course, then you can argue that, oh, maybe it doesn't hold true in the future because XXX scenario. So that's possible too. A VAR does not aggregate, so you cannot aggregate VARs. It makes no sense. You cannot say, oh, a VAR of 500 plus a VAR of 200. It doesn't. You can't do that. Of course, the VAR also fails to incorporate positive value to provide overall picture. So yes, you might lose, let's say 10,000, right? But perhaps you can actually gain 20,000. So it doesn't include this positive value, and therefore it doesn't give you a full picture. Okay, so managing market risk, we already talked about some issues regarding the VAR, and then there are also a lot of various techniques. So there's like risk budgeting, so setting what's the risk level you can accept, how much loss you might be able to accept. We already talked about the VAR. There's this thing called stress testing. So any of you are in the finance industry, this is finance and risk component of the industry, this will not be new. So stress testing means that you kind of like force the VAR to be as big as possible. So give various scenarios so that the VAR is as big as possible. So you stress the VAR, right? So you see what's the maximum minimum loss that you can incur, right? Scenario analysis. So you tweak one. So scenario is basically you take at least one variable in your model and see how it actually affects your result. So performance stock. So what's the maximum amount of loss that you allow to incur? After that, you should like not trade on a portfolio anymore. Position concentration limit. So what is the limit of concentration? So how does this position concentration limit happens? Is that as you have a portfolio, right? So you must always remember it's a big portfolio. And the thing is, let's say in your portfolio you have stocks, and if the stock price keep on increasing, yes, it might be good because you have some returns, but because the stock price keep increasing, your percentage of the proportion of your portfolio relating to stocks would keep on getting higher and higher, right? And that is a very risky position. as we will see also in your TMA, right? It's a very risky position because you have so much value in stocks. And so you need to do some rebalancing. That's where rebalancing happen. And in this sense, this is the position concentration. So if so let's say you set the portfolio in the IPS, say that, oh, you know what, if the concentration of stock shouldn't exceed 40%. So once it exceeds 40%, something has to be done. So this is like to manage risk, right? Because you know stocks are high risk. Leverage, so you specify amount of leverage. And remember, when we think about leverage, don't only think about borrowings, right? Don't think about loans, because you know when you do certain instruments, like you do short selling, basically you're taking leverage when you do short selling. Later we'll look at this thing called a forward. A forward is kind of a derivative instrument, and forward is also a leverage position. So when we think about leverage, do not think of physical leverage in terms of borrowing. Think about how the various instruments that you recommend could introduce leverage indirectly to your customer. Any questions? No, we're good. Okay. So I'll just touch a bit on this credit risk. So the idea of credit risk we mentioned is a very large impact, small probability event, right? That we're trying to identify and try to mitigate or try to hedge the risk of this event happening. All right. So usually it's very rare, but the amount is very big. And the problem with credit risk is that more often than not, they tend to be correlated to the market. So for example, in the financial crisis, obviously the credit risk of a lot of companies will shoot up very high, right? The chances of their default is very high. So which is why we did the last lecture on studying the market. But at the same time, it allows us to understand more. Okay, so if it's a financial crisis, what should you do to mitigate credit risk? And of course, in a financial crisis, the credit risk of companies basically converges, and so most of the company become very high and at risk of default. This is from like a bank perspective, very high risk of default. And if you are a portfolio manager, you should be very careful, right? If you're going to recommend equity to your client. So so rather than kind of just offering like buy a stock, right? Could you actually offer your client something else, a derivative instrument? And this is what we're going to look at. We're going to look at forward contracts, we're going to look at swaps, and we're going to look at options. Okay, so we're going to think about this. And remember, all these are, some of y'all might already be trading all this, but we are going to look at these three derivative instruments from a risk management perspective. So we are not trying to make money here, we're trying to avoid risk. All right. So if some of you are already trading these, you know that you can actually make quite a lot of money with this as well. But we are going to try to understand it from a risk perspective. Okay. Okay. So you know what? Before we start on forward, let's just take a quick 7 minutes break. It's a bit early, but you know, let's just come back in 7 minutes because this part will go for quite a bit. Let's come back in 7 minutes time. So that will be 7:55. 55. Yeah. Of course, at the end of the day, if you have any questions, feel free to type in the group chat. We'll answer after the break, right? So as usual, we do 2 short breaks so that you can just rest a bit. All right, welcome back. Hope you have a good short break. Okay, so for this part, we are going to talk about measuring credit risk, but in terms of using derivative instrument. Just a quick, quick poll, quick check. How many of you all have taken this derivative course before? I recall there was at least one person have taken it. No, okay. I guess, okay, so maybe that person who taken it, a bit shy to say, but okay. So I'll assume that none of you have taken it. So if you go and read the study guide, they'll talk a lot about this derivative, forward, swaps, option, right? But the problem I think that you might face when you read the study guide is that if you don't even understand what is a derivative, when they say, oh, the increase, decrease, and everything, you will not kind of be able to visualize what it means, which is why if the next few slides, you'll see a lot of like this kind of graph to explain to you how the derivative work. Just want you to take note that you don't have to memorize any of this, like how to draw and stuff. It's more conceptual so that you can understand what's a derivative. Like, for example, what's a forward, right? How does it look like in terms of like this kind of graph, to understand the concept of how you mitigate credit risk. So just want to say again, you don't have to memorize any of these like situations. You just really just need to understand how does this instrument work so that you can use it for credit risk management. All right. So if you're going to compare slides with your other friends from other tutorial classes, they might not have even all this, right? But it's basically just words in the study guide, and I feel that if you're just going to read like the all this explanation like a storybook, you probably will not understand. So using a graph is quite important. All right. Okay. So so much about that. About the forward. So forwards are almost like a stock. Why do I say that? Okay. So this is the payout profile. I call it the payout profile of a forward. If you notice, the forward price basically acts like a stock, right? The price just keeps going up. So a forward is like a stock. But the only difference is that in a forward, there's no cash up front that's being paid. Like if you buy a stock, you pay something up front, right? But for forward, there's nothing being paid up front. Basically, what you're trying to say is that you buy an agreement to say that the price of, let's say, a stock, let's say ST Engineering stock, would be, let's say, $50 in 5 months. So you buy a forward of that agreement, right? And then after 5 months, did it reach $50 or more than $50? So after 5 months, if you reach more than $50, then you start earning profit. So you buy a forward here, there's zero profit. Let's say after 5 months, the stock of ST Engineering, which you say that you buy at $50 in 5 months, if it hits $60, so you earn a profit, a small profit here. So a forward gives you a profit. But of course, after 5 months, if the stock of ST Engineering drop to $40, right, then you'll start making losses, right? So the thing about forward is that it is like buying an agreement of what the price of the stock is in the future. All right. So because of that, prior to expiry, there's actually no credit risk that exists. You're just buying an agreement, right? But the credit risk exists at payment. So at the end of the day, right, for forward, if the agreement is on netting, okay, so we'll talk more about netting. But netting, what it means that you don't pay up the principal at all. So there's no exchange of principal. Basically, you just net off the amount and you pay the difference. You just get profit or the loss. So there's no exchange of principal that's happening, right? So if you agree on netting this in the agreement, what happens is that you buy a forward, and at the end of the day, you just pay the difference, the profit or the loss. And because of that, whether the party can pay you the profit would result in a credit risk event happening. So the credit risk event happens at the end of the forward when you need to do the netting process or when you need to pay off the profit or the loss. So the question is, what are the motivations of buying a forward, right? So the good thing about buying a forward, like I mentioned, you don't have to pay anything upfront. You're just buying agreement, right? So it's almost like taking a leverage position. So I want to highlight this is that sometimes if you see in case study, they buy a forward, right? You need to identify immediately that you're actually doing a leverage position, but it's a very indirect leverage because the thing is there is no underlying, right? Underlying means you're not buying a physical stock that you can actually sell in the end. You are just buying an agreement that would ask you to pay the profit or the loss. Of course, when you buy a forward, you need to have a view. Like you need to know what the price of the forward you are buying. $50, is it the price? Because you assume that, or your view is that the price will increase to $60. So you have to have a view. Okay. Any questions for forwards? What's a forward? So again, understanding the concept of forward and all these instruments is very important, but you need not draw the graphs and all. So it's just understanding. No? Okay, so much for forwards. So forwards are very easy. They are like the most standard or the easiest kind of derivative instrument to understand. Now, let's look at what's a swap. So a swap, right, is again agreement, all right, agreement to exchange cash flow for some time in the future for a specific thing, right? So there are three kinds of swaps that we look at. We'll look at interest rate swaps, we'll look at equity swaps, and currency swaps. So there are three kinds of swaps. So the thing is that they differ slightly here and there, all right? So you have agreement to exchange the cash flows, all right? But there is no cash that's being paid upfront again. So there's no cash that's being paid upfront again. This is very important. It's almost like a forward. So what is happening is that at the end of the day, the proceeds just net off. You just pay the difference. So one party will pay the other party the difference, and that's all, right? So no cash upfront again. And what's important to take note is that only for currency swap, there will be a change in notional principal. It will be exchanged. We'll see this example in a bit, but it means that only in currency swap, we will actually really give the principal to the other party, right? To swap the principal. But for the equity swap and the interest rate swap, we are just going to swap the, first of all, interest for interest rate swap, and for equity, we're going to swap the difference in the payout, and that's all. All right. Okay, so we'll look at what interest rate swap is. This is perhaps maybe the easiest of the swap to understand. All right. So interest rate swap basically allows you to convert a liability or an investment, which is an asset. So you can convert a liability to fixed to floating, or you can convert the investment or asset from floating or from fixed to floating or floating to fixed. So basically just convert, right? You are basically converting the interest rate. So let's look at this example of a swap. Okay, so this looks complicated, but don't worry, it's not too complicated. So you have MS, Microsoft, or Intel, right? So now you know that let's look at the side of Microsoft first. So this is the whole sphere of Microsoft, right? What's happening in Microsoft? So Microsoft actually borrowed money from X. X is somebody like, we don't know who is that, X, and agree to pay out LIBOR plus 0.1. So I hope everyone knows LIBOR plus 0.1. And if you are in the industry, you know LIBOR has already been phased out, and then we use SORA and whatever. But basically, this is a floating rate, right? So LIBOR is what is the rate on the market, like imagine like a market, right? Plus 0.1. So there's 0.1 added onto the market rate, all right? So this is a floating rate. Now, Microsoft doesn't want a floating rate. It wants a fixed rate. So fixed rate means that the rate doesn't change based on the market. So LIBOR plus 0.1 will change with the market, right? The market rate go up, your LIBOR obviously go up, and then your rate goes up, right? So it wants to enter an interest rate swap with Intel, right? And the thing is, Microsoft is going to pay Intel 5%, okay? And Intel is going to pay Microsoft LIBOR, right? So So Microsoft will pay 5% to Intel, and Intel agrees to that, okay, you know what, we are doing this swap process. I'm going to give you LIBOR here now. What happens is that, can you see that the LIBOR is being passed from Intel to Microsoft, and from Microsoft, this LIBOR will be passed to X, which is where Microsoft borrowed the money, right? The net effect is that Microsoft will simply pay a fixed rate of 5.1%, right? 0.1 here and 5, so 0.1 to X and 5% to Intel. So what have we done here, right? We have basically converted a floating rate loan of LIBOR plus 0.1 to a fixed rate loan of 1.5%. All right. Everyone okay with this? Any questions? You can unmute yourself, or you have any queries or comments on this interest rate swap? How does it happen? Okay, that's a good question. What's the motivation to swap with MS? So basically, the motivation of Intel and MS can be very different based on their perspective, what kind of scenario they believe will happen. So for Microsoft, they feel that maybe the floating interest or the rate in the market will increase over time. So they don't want to be exposed to the increasing interest rate or interest rate risk. So they rather take a fixed rate. All right, that's for Microsoft. But maybe Intel say, you know what? The economists in Intel has like maybe special information. They say actually the market interest rate is going down. So I want a LIBOR. Basically, I want a floating so that your total interest will be down. Right. So this is really based on their perception, what the company think would happen, the market perception, and how you get that. We have lecture 3 to explain it, right? You know, how you derive various market perceptions. Yeah, I think I answer so the second. Yeah, what scenario? Right. So if you believe that the interest rate is going down, so remember we talked about how interest rate might be going down, up. Remember we talk about inflation. We talk about some monetary policies and stuff. Yeah, so those all come into play. So of course, you know, in a case study, right? If you are able to explain this, right, and you bring in the idea of monetary policy and stuff, yeah, that would be like a really good A+ answer, right? Because you really bring all the concepts. Okay. Okay. So, you know, at any point, if you have any questions, you can simply type in the group chat. Now, let's look at this. So on the Intel side, what is happening? So Intel side, right? Let's say it also borrowed money, right, from W now. So W is somewhere here. It's not here. It's not in this chart, but W. And it has to pay out fixed interest of 5.2%. But let's say, you know, Intel thinks that, you know, the market interest rate is going down. So he doesn't want a fix. He wants a floating. So what he does, he did a swap with Microsoft, and in turn, you will pay Microsoft the LIBOR, and he'll receive 5% from Microsoft. In essence, what's happening is that he would pay out interest of now LIBOR plus 0.2%. So Intel is going to pay LIBOR plus 0.2%. And he actually swapped his fixed interest to now a floating interest rate because of the change here. All right, everyone okay? Okay, so if you're good with interest rate swaps, now let's talk about equity swaps. So how does equity swaps happen? So equity swap, right, you must always swap it on an index. This is something important here. On a stock or stock index. So what's happening here? So Mandy is, let's say, the main person, okay? This whole thing is about this person called Mandy, right? So Mandy has a portfolio of equity, let's say the S&P 500, and she received a S&P 500 return every every year, let's say, right? But you know what? Maybe Mandy feels that I don't want the S&P 500 return because the S&P 500 return can fluctuate over time. I want something that's fixed because let's say Mandy's retired, she wants like almost like a fixed bond kind of coupon, so like which is fixed. She doesn't want to take risk, right? So she does a swap with a swap dealer to pass the S&P 500 return to the swap dealer. And the swap dealer say, you know what? Okay, if you pass me the S&P 500 return, what I'm going to give you is 9.5% per annum per quarter, right? And based on this notional and a tenor of 3 years, so this swap will expire in 3 years' time. All right. So what is the motivation of the swap dealer? The swap dealer feels that the S&P 500 return will increase over time. That's why he don't mind taking the S&P 500 return. Now, for Mandy, maybe she's afraid of the variation, or she doesn't want to take the risk of the fluctuation in S&P 500 return. So she does a swap with the swap dealer. So effectively, what happens here now, right, is that you are actually creating almost like a bond, right? Because your bond pays you coupon every semi-quarter or no, semi-annual or even annual, right? And so what Mandy is doing is she's taking almost the return of a bond instead of equity. So how is this very applicable to your case study, right? For example, you have a client, he has a large equity portfolio. So I'm going to refer back to a TMA because all of you have done a TMA, right? If you know that one of the person, I can't remember his name, but the person had a very large equity portfolio, right? So one way to mitigate this large exposure to your equity portfolio from his company, I think it's like 80% or something like that, right? It's actually do equity swap. So obviously you don't have, the question didn't ask you to do that, but in case, in like your finals, they talk about this large portion of equity stock. What you should propose is to do equity swap to reduce the risk, right? If you notice in the case study at TMA, the returns are much higher than what he wants. He only wants, I think, 3%, right? So what you can do is you do equity swap to get a fixed return and give away your equity proportion. So you remove the equity risk and you just get fixed, which is what we're trying to do here. So this is like from a risk perspective, right? We are trying to mitigate the risk because you already meet your returns. So we don't need so much returns. So you do a swap to reduce the risk for your client. Okay. Any questions for this? So similarly for the interest rate swap, if you notice that your client has a lot of floating interest rate, and maybe the case say like, oh, the market is experiencing high inflation the next 4 years. And we know that when inflation increases, interest rates will increase, right? So what should you recommend to your client? Quickly do an interest rate swap. Get a fixed interest rate for the next 5 years. So you need to specify a tenor as well. If you know that next 5 years, interest rates going to increase, do a 5-year swap. And yeah. And then so you can help your client to save money, basically. Yeah. Any questions? Okay, we're good. All right. Now, so those two swaps are more or less quite simple. Okay, the currency swap is a bit more complex, but not too complex. But remember, I want you to highlight one thing or to write down your notes that for a currency swap, the notional principal will be exchanged, meaning that the amount, the principal here will be exchanged. So you need a cash upfront, a cash payment upfront immediately, right? Because you're not just paying the profits and all those things that we talk about. Okay, let's look at this example here. So we have this Royal Tech Limited, Rotech, which is a British high-tech company. It plans to expand, okay, in Europe, and it requires 30 million pounds, okay, for the expansion plan. The currency exchange rate is this. Expansion, and so the expansion cost would be this. So we know that 30 million pounds will give you this in euro, all right? Now, so Rotech could issue a euro-denominated bond, all right, but it's not well known in the Euro market, right? But in the UK market, you know, they are kind of like still investment grade. So it's still all right. So now Rotec could issue the pound denominated bond and convert it to euro using a currency swap. Okay, so this is a very typical reason why people want to do a currency swap. First of all, in a case, when you read the case, right, you need to be very sensitive. So, for example, if they say that this is a British company, right, in this case, or this short excerpt here, because it's a British company, they might not be experienced in the euro market. So, because of that, yeah, it makes sense for them to still issue the bond in the British market, but do a swap to euro so that they can do the expansion in the euro market. Okay, so what's happening here is that Rotec is here. They issue a bond in pounds, and the bond holders basically pass them the money, right? You know, remember we talked about bond, right? Bond is like what's a bond and all? We have mentioned it previously or even year one. So what's a bond? So basically, when Rotec issued a bond, they get 30 million pounds. Okay, but remember he wants to expand in euro. So what he does is he approached, let's say, a broker or like a swap party, right? Or swap bank, SB, swap bank. So Rotec basically just pass the 30K to a swap bank, and a swap bank will pass him the amount in euro. That's all. Yeah. So it's almost like a money changer that is happening here, right? You are changing the notional principle. So maybe the question you might be wondering is that, okay, for the swap bank, how do they earn a profit, right? So almost like a money changer, basically, they give, first of all, they might give Rotec a very bad rate, or second of all, they might charge some swap fees that when Rotec does the swap. So at the end of the swap, maturity for the currency swap, basically Rotec have to pay back, let's say, this amount of euro, and then the swap party will pay back this amount of pounds, and then Rotec will return it to the bondholder. Okay, so again, any questions, just feel free to type it down below. But what does this currency swap does? So in case, you know, when you read a case study, you see that, oh, you know, they say that this person is exposed to X currency, say US dollar currency, right? But at the end of the day, you know that this person is residing in Singapore and he's going to retire in Singapore. So perhaps you can actually recommend do a currency swap for him, right? From US dollar to Sing dollars, because you know he's going to retire in Singapore, but maybe he's working in the US now, you know. So this kind of like scenarios should bring up some idea of, okay, maybe I should recommend a currency swap for your client. Okay, so let's look at the credit risk relating to a swap. So the market value of swap is calculated by the present value of the amount of risk, not too complex. Okay, so for interest rate and equity swap, the highest risk event happens at the middle of the swap period. Okay, let's understand why. For interest rate and equity swap, right, beginning of the swap process, usually both parties would do a lot of like analysis, fundamental analysis on the company, on the broker, etc. So like a lot of analysis being done. Because of that, usually the credit risk is low. Now, at the end of the swap, we know that there's not much payment left, right? For example, in an interest rate swap, right, you're going to swap the float fixed to floating or floating to fixed let's say every quarter or every semi-annual, right? But at the end, let's say after 5 years, right, you only know that you're going to swap 1 or 2 more times, and that's all. And because of that, the risk is very low, right? The credit risk is very low. So you're quite all right, you know, not swapping. As in if the party default and can't swap, that's fine. You just find another swap party. Now, what happens in the middle is that because the counterparty's rating or maybe the credit conditions might cause the party to maybe, let's say, go into bankruptcy, right? And you remember, you're in the middle of a swap. So to unwind the swap and to find another swap party to take over, let's say your loan is 5 years, and we're doing called interest rate swap. So you want to find a party to cover 2.5 years, it might actually be very difficult. So if you are a trader, you know that finding a swap of like, let's say 2.5, like this 0.5, right, might be very difficult because the market might not actually have such a product for you to swap. And because of that, your swap risk, credit risk in the middle is very high. Okay. For currency swap, the greatest is the middle and the end. Okay, why the end? Because remember that at the end, you need to do the principal repayment, right? So you basically are swapping the actual principal. So that's why it's very high at the end. But at the start, it's not high, even though you swap the principal, because you have done all your fundamental analysis and all of the company. So the risk is low. It's always at the end when you need to swap back. Let's say the company does not have the money to return you. In that case was pounds. Then you have an issue, right? How are you going to pay your bondholders in pounds? Okay, so if he has a total expansion cost, okay, so yes, so you can mention that there might be some swap transaction costs that should be considered. So in a currency swap, right, when you do the expansion, when we did this expansion, yes, so you see might be very like clean, right? But actually in real life, there's first of all transaction costs, and the swap bank might give you a very low rate. So those are things that you consider. Okay, so last but not least, we're going to talk about options. So options, there are two kinds of options: American options and European options. Most textbook or what you read about will be this thing called European options, and what we're focused on. Why? So what happens in the European option is that you can only exercise this option at the expiry date. Okay. But for American options, you can exercise it anytime when the option is alive. And this would translate to the kind of credit risk. So in American options, your credit risk can happen anytime, but in the European option, your credit risk is the highest at the expiry date. Okay, so there's this comment say, short declares bankruptcy before expiry, the long has to claim on the very options. But let's first of all understand what's option first, right? Because I believe not everyone knows what's an option. So what is option? An option, there is two kinds of option, a call option and a put option. A call option means that you are going to buy the stock, or you're going to buy the option, call. So call to buy the stock. A put means that you're going to sell the stock. Okay. So what happens if, okay, so that's a call and a put. All right. Now, what's a long and a short? Long means that you obviously buy the option, right? Short means that you're selling the option. Okay. Remember, when you do a short call, right, you might not have the stock in your hand. So what I'm trying to say is that your option, it becomes a leverage position. You're actually buying leverage. All right. So what's happening here? So if you long a call and you know that there's a strike price, so strike price means that this is the price where, of course, there's no payoff. There's the price that almost like the price that you buy, right? Yeah, you can think of it like the price that you expect the call to be at. Okay, so if you buy a long call, and then you know that because you're longing the call, if the price of the stock increase, because remember, long call means that the option is to actually buy the stock, right? You have an option to buy the stock in the future. So you know that if the stock price increase, you're going to get a payoff because you have to buy the stock, right? So when the stock price increase, you're going to get a profit. All right. Now, what is a long put? So long put means that you're going to buy the option to sell the stock. Okay, so if the stock price decrease, you are going to get a profit, right? So that's why the payoff is positive when the stock price decrease. So if you have understand the long side, the short side is basically just the opposite. You're going to short the call instead, right? So when you short the call, what happens is that if the stock price increase, you still have to sell, right? Because you're shorting the call, which means that your payoff is negative, similar to a short put. Sorry, for short call, you have to buy the stock regardless, right? You're shorting the call. So when the stock price increase, you're going to make more and more loss. So if you notice for short position, right? Remember last lecture we talked about long short strategy. So the thing about short strategy, right, is that if you notice the payoff of a short call and a short put, the negative payoff is unlimited. There's no cap. Can you see that if the price keep on increasing, of the stock price keep on increasing, you have to buy the call option regardless whether it increased by how much. And because of that, this would incur a very large loss, similar to a short put. There's unlimited losses, that's why a short position is quite dangerous. Most people don't want to take a short position, they rather take a long position, right? A long position, can you see that the loss is being capped? All right. Any questions regarding these options? Oh, okay, that's a good question. So what happens is, remember the last lecture we talked about long short position. So people, yes, they might take a short call position, but usually it's not by itself. So if you do a short call position, they might do a long, because remember, a short position, you're taking leverage, right? You're taking leverage means that you don't have to, first of all, options don't have to pay upfront anything. You're taking leverage. But what happens is that you can combine this short position with another long position because you are taking leverage in one position. Remember when we talk about leverage is like the negative weight, because you're taking a leverage, you can actually buy, let's say, another product. Let's say you buy a stock and you can combine the payoff together to get a different kind of payoff, right? And a better payoff. Okay, let me just draw this out quickly. Okay, so this part is not in your syllabus, but what you can think of is this. Okay, so this is a stock return, right? A stock return is just a normal return here. Okay, it's going to increase, and then, yeah, I mean, if the price drop, is going to decrease, it will increase. This is a normal stock. This is a normal stock. Okay. Now, let's say, right, we are going to combine this stock with a okay, we're going to combine this stock with a long put. Okay, so you can do it with a short as well. You can combine different things. You can combine anything that you want, all right, when you're recommending to your client. So this is a long put. And then this one's a stock. Okay, so what actually happens now? When you combine a stock with a long put, what you are getting is this thing called a can you see the payoff profile when you combine both would be this orange part here, because this up and down basically cancel each other. And then your flat and increase basically result in an increase, right? So what you're getting here? Now, you're getting when you put a long put and a short, you actually get this thing called a protected put. So protected. So you are protecting your put position. Okay? So it's a protected put position here, which is quite interesting, right? You basically are combining options together to give a protected put. Why is it protected put? Because when the price decrease, let's say the stock price decrease, you are being protected, but then you can get an increase in price, right? Now, the question is, isn't a protected put similar to a long call position right here? Because a long call is like this, right? Now, the question, the issue is sometimes in the market, there is no long call position, or buying a long call position is very expensive. It's so expensive that if you buy a stock and you buy a long put, that will be cheaper. Usually a long call position, everyone wants to buy a long call, right? It's quite good. See flat payoff if it's negative and keep on increasing. So everyone buy a long call, but it's so expensive. So sometimes you can create your long call position. So this is the reason why sometimes you might actually do a short call as well. Basically, you're creating so-called a synthetic position for your payoff structure. Everyone okay with this? Okay. Okay, so if everyone's all right with the idea of what's a call, what's a thing, then you should be able to understand this whole idea of credit risk already and how to mitigate it, right? So in terms of derivative, there are a few things. There's a thing called mark to market, where you actually have to mark the value. Basically, the party will pay off the differences, right? Mark to market. So at a certain point, you have to mark to market the derivative. So for example, the derivative is trading at $10, but the market value is only $5. So at regular intervals, you must write in the agreement. Like let's say every month, you have to compare your trading price of the derivative with the market value, and then you have to pay the differences. So these are mark to market. All right, this will reduce obviously all your credit risk. You might have collateral. So collateral is basically like a guarantee, right? Like for example, a collateral could be a cash waterfall, or if you don't know what's a cash waterfall, basically it's a cash holdings, right? You have to set aside certain cash to pay off your derivative. So sometimes in your contract you might have this cash waterfall thing, waterfall kind of idea. You might have a netting. We remember I briefly talked about netting. So netting, what happens is that instead of paying the differences, so let's say in the example of a swap, instead of paying, let's say, remember we have LIBOR plus 0.1 for MS and 5.2 for Intel. What netting does is that, you know what, rather than I keep on paying you LIBOR and keep on paying 5.2, not 5%, but 5%, and the other person pay the LIBOR, right? We net off the difference. So what is the difference between LIBOR and the 5%? So we just net the difference, then the party pays whoever, all right? So you're just giving the differences. You don't keep on passing LIBOR and you don't keep on passing 5%, because what's the point of keep on sending so much money here and there, right? You just want to net off the difference and just pay the difference. How do you reduce risk? You have rating agencies, no big deal, and you have cross-default provision. Anyone know what's a cross-default provision? Everyone familiar with this idea of a cross-default? Okay, so maybe just to quickly explain what's a cross-default. A cross-default means that you are going to, so let's say a bank could have multiple contracts with like, let's say 5 different parties, right? Let's say 5 parties. Now, a cross-default position or provision means that if the bank defaults on one of the client, it will cross default all 5 clients or all other 4 clients. So basically the default will cross each other. That's the meaning of cross default. So what does this mean? It actually protects the customer of the bank, right? If the bank has a cross default, right? So if one customer default or the bank default on one customer, means that the rest of customer, you default on the rest of customer. So the other customer can start claiming from the bank whatever money because the bank has defaulted. So there's a cross default position, provision. Okay, last but not least, how to reduce. I want to explain this thing called a credit default swap. So this is a very popular swap, especially during the 2008 financial crisis, which result kind of in the financial crisis. Part of the reason, not all. Part of the reason was this idea of a credit default swap. So what happens is that you are the protection buyer. Okay, so for example, you hold a reference asset. So you hold some asset here, right? Let's say you hold S&P 500. Not that S&P 500 can default, but let's say you hold one stock, right? Let's say you hold like ST Engineering, okay? Now, you are very afraid that ST Engineering is going to default. So I'm going to buy a cross-default swap from this protection seller. So this protection seller would agree in an agreement to say, if ST Engineering default, I'm going to pay you X amount of money. All right, so basically, the protection seller takes over the credit risk of ST Engineering. But in return, you as the buyer of the protection who have to pay this protection seller a fee. It's almost like an insurance. So imagine like an insurance, right? So this is how a credit default swap happens. Of course, remember at the end of the day, right, the payout only happens when a default event or credit event occurs. Now, if the credit event never occurs, basically, it's like insurance, you just keep paying. So it can be very expensive actually to buy a credit default swap because you keep on paying. If they never ever default, which is good for you, you just keep on paying and then it's a lot of money basically. It can be this credit default swap, depending on the risk of the company, can be very expensive. So we're not talking about like $500, right? Not like a small insurance, can millions of dollars just for a swap. So that's the reason why. But of course, you reduce your credit risk. Everyone's okay with this credit default swap? Very useful instrument. For example, let's just talk about the TMA case again. You know that this person, let me just see what's the name. Is it Dennis? Is it Dennis or yeah, Dennis, right? So Dennis has like a high risk exposure to his company, right? Because he has a stock of the company. So not that you have already that you have answered it this way, but what you could have answered if they ask you about some issues or regarding the stock holdings is that what if the company defaults, right? What if Dennis' company default and couldn't pay him the stock price or whatever, right? So what Dennis could do is do a credit default swap. So he swapped this with a protection seller. So in case Dennis' companies goes in default, the economy crash, it bankrupt, he can get back the full amount of money from the protection seller. Of course, at a fees, you have to pay a fees. Right? So why do we need to do? Okay, so that's all for credit risk management. So any questions before we move on to rebalancing? So rebalancing, yeah, there's quite a bit of calculations, but it's much more it's technical. Just follow the process, right? Just now, risk management is a bit more fluid. There are a lot of things that you can do to manage your risk. I'll just pause here for a short while. Any questions? We are good. Okay, now if we are good, let's talk about rebalancing. So remember just now we say that, or I mentioned that, if your stock price keep on increasing, then you might actually cause your portfolio to be imbalanced, right? Because the amount of weight on stocks will be super high now. All right. So because of that, we need to do some rebalancing. And remember, your asset allocation is based on your IPS, right? So you need to really follow the IPS. So even though your stock price keep on increasing, it's good for you, get a lot of returns, you must follow your IPS, you must rebalance based on the agreed asset allocation. Because remember, if your asset allocation is so heavy on stocks, you're actually taking more risk than what your client wants. Okay, so frequency and degree of rebalancing will really depend on how you measure the rebalancing, and at the same time, also what kind of weight and location you set aside, right? So if you allow for more rebalancing drift, then you might not need to rebalance so often. Okay, and these are some methods that we'll look at on how to do rebalancing. Okay, sorry, just give me one moment, 1 minute. Let me close the door. It's getting a bit cold. So it's snowing now outside. It's really heavy. One moment. Sorry about it. It's snowing really heavily. Okay, so let's go back to rebalancing. So when do you rebalance? Basically, when the benefits of rebalancing outweigh the costs, right? As in most life choices, right? Cost benefit analysis. So there are some issues with, or actually benefits of rebalancing. First of all, we might lower the weight of an overpriced asset, all right? But most importantly, we want to maintain the desired risk exposure for the client, right? So I hope that whenever you answer questions on case study, right, always fall back on what is the risk appetite of your client, right? Talk about risk willingness, risk ability, risk tolerance, of course. And yeah, at the end of the day, you also want to maximize the utility of your portfolio. Now, what are the costs? There are a lot of costs relating to rebalancing, and that could include, some commissions. You have your opportunity cost, market cost, bid-ask spread, tax. Yeah, so a lot of costs to consider, right? Nothing too complex here. Okay, so we have this example here, where rebalancing might be required. So you have the initial asset allocation of this for Ray. All right. Now, does he need rebalancing? Let's look at the next slide to see whether he needs rebalancing. Okay. So this is the initial, which is what we saw. Now, the current is this. All right. Can you see that? Let's look at percentage of stock. Now, at the start, the strategic asset allocation, SSA, is 30%. Can you see that your current has fallen? So your stock asset allocation has fallen. All right. But what has actually increased? Oh, you know what? Maybe your long-term bond has actually increased compared to your strategic allocation, and even your commodities have increased. So what do you have to do? Basically, you do a rebalancing of the trade by selling or increasing certain components in order to maintain the weight that you require. right? Because you see your initial portfolio is 100K, but then after that, your current portfolio price has increased. Okay. So when do you rebalance? We can rebalance, first of all, on the calendar day. So calendar day means that you just rebalance periodically. So every, let's say, quarter, you rebalance, all right? But yes, you might rebalance often, but you might incur actually very high rebalancing costs, right? As we see earlier, if the more you rebalance, the more cost you result in. Now, there's another way to rebalance called the percentage of portfolio rebalancing. So this is where you have a fixed amount of, let's say, just now, like what we saw in the example, right? We have fixed amount of stock, 30%. So whenever it breach these, we must set we can set a range, right? Or a fixed amount, a fixed threshold. So there's two parts. We can allow a range or a fixed threshold. So this one or this one, right? So once it breaches that fixed threshold or range of threshold, then we need to do rebalancing. Now, the thing about this percentage of portfolio is that if we do a range is good because we don't need to rebalance so often, right? So we allow like a 5%, because remember your portfolio value can increase and it might decrease again, right? So yes, your stock might increase, but if it's below the upper limit of the range, that's fine, right? Then if it decreases later, then you save on rebalancing costs. So usually a range is quite good. Try not to do a fixed rebalancing. Of course, it also allows a portfolio manager to manage the weight better, right? You give more flexibility to portfolio manager. Now, what you can do also is you just combine calendar and percentage of portfolio rebalancing. So you just combine both, right? So means that if it breaches a certain range, you rebalance, and at certain intervals of the year, you rebalance. So regardless, you just rebalance. So you can do that too. So equal probability rebalancing means that you calculate what is the standard deviation of each asset, all right? And if it breach a certain standard deviation of the asset, you rebalance the asset. So because you're calculating the standard deviation of each asset rather than the standard deviation, or not standard deviation, rather than the percentage of the portfolio, so you're doing each asset, basically each asset has the same chance of being rebalanced at every point in time, because you're talking about each component, right? Each asset class. Tactical rebalancing, basically the idea of tactical is always to achieve alpha. So, we can rebalance maybe less frequently or more frequently based on certain, experience that you might have or certain characteristics that you have, right? At the end of the day, you want to capture more value in the rebalancing process. All right. So those are all your rebalancing strategies. Okay, so why we talk about all these rebalancing strategy is based on your client's, let's say, risk appetite, or maybe his ability, risk tolerance. You should recommend various types of rebalancing, right? Whether is he a very conservative, maybe he wants more rebalancing to be done, then you can recommend, okay, maybe do a calendar year account, or maybe calendar month, not even year, calendar month rebalancing if it's very like conservative. But at the same time, you might say, oh, but the cost is very high, so maybe I recommend the portfolio percentage by portfolio. So this is how you can actually answer the question. All right. So rebalancing strategy, let's just carry on. So how does this work? Let me give you the big picture first, okay? So when you talk about rebalancing strategy, it basically means the kind of profile, the payout profile that you're trying to achieve, right, in this rebalancing. And the examples that we're going to look at will be very simple because we only consist of a stock and a risk-free asset. Risk-free asset meaning like a government bond. So two things, right? Stock and risk-free asset, and that's all in your portfolio. But of course, we know that in a portfolio, it consists of more than that. We can have gold, we can have commodities, we can have what else? Real estate, REITs, we have a lot of things. But in this example, we're just throughout the rest of the slides, we're just only talking about stock and a risk-free asset. Okay, and this formula is arguably the most important to understand this concept of rebalancing strategy. Okay, so what does this formula trying to say? The stock return or the stock amount of stock that you should hold would be determined by this thing M, which we'll talk about a lot about this M, but this constant called M, which is between 0 and 1. 0 and 1. And this thing called the value of the portfolio minus the portfolio floor value. So portfolio floor value means that the portfolio shouldn't fall below this floor value, right? And what's the portfolio value? So remember, your portfolio only has two stocks, two items, right? The stock and the risk-free asset. Okay, so this portfolio value basically gives you the combination of the stock and the risk-free asset. So what we're trying to find out is how much stock do we require, right? When we know how much stock we require, we kind of will be able to understand how much risk-free asset we'll have. Okay, all this will become clearer once we see the various strategies. Okay, so we have three strategies. The first strategy that we're going to talk about is the buy and hold strategy. It's perhaps the most simple example of this rebalancing strategy, where we'll hold, of course, the risk-free asset and the stock. Okay, but the risk-free asset and stock will be held forever, means buy and hold, like what I say, buy and you hold it. Okay, so the amount of stock, the amount of risk-free asset basically becomes the floor of your strategy. Floor meaning the minimum amount, because remember, you're going to buy and hold the risk-free asset stock forever. So the risk-free asset will be the floor, because the minimum, let's say the stock goes to $0, what you have at the end is just the risk-free asset, right? So that will be the floor. Okay. So market change aren't used to rebalance the risk, the portfolio, because remember, just buy and hold, and that's all. We're just going to hold it. It's a linear relationship. Okay, so we'll look at this in a bit, but it's a linear relationship between the portfolio value and the performance. Okay, in a rising market, the portfolio exposure to risk-free asset increase. So what does this mean? When the market is going on an upswing, your stock price increase, right? And because your stock price increase, what happened? The percentage of your portfolio attributed to stock becomes very high, right? So your risk will increase. So this might not be such a good strategy, right? If your investor has lower risk tolerance, right? Because you're going to buy and hold, and that's all, right? Yeah, we'll look at some other examples, two more example strategy in a bit. So what does this mean on the graph? So this graph, I like to show it. Again, it's not in your study guide, but I think it helps you understand the concept of buy and hold strategy a lot. So at the start, right, when the price of a risky asset is 0, right? Remember, you have a floor. The floor is basically your risk-free asset, right? When your risky asset is 0, the floor is your risk-free asset. And so, of course, you buy and hold, and that's how you just keep holding, right? So as your risky asset price increase, your portfolio price increase. So in a sense, it's a bit simple. Okay, so how does this relate to the equation that we talk about, right? So the amount of stock, remember your M, I told you M is like a constant that we talk about, right? In this case, the M is 1. Why is it 1? So when you plug it into the formula, basically, remember, this is what M times this whole chunk of thing, right? And because your floor value of your portfolio is equals to your risk-free asset or your cash equivalent value, right? So basically, your amount of stock equals to the amount of the value, dollar value in your portfolio. right? So change in stock equals change in portfolio value because your floor is simply your cash and cash equivalent or just your risk-free asset. So I'm just going to jump back up to the slide here again. So remember this equation, stock equals to M times what's the value of the portfolio minus the floor. So in the buy and hold strategy, your floor is your risk-free asset, which is your cash, right? Which you're going to hold all the way. And the portfolio value is basically your stock value. There's no, so your M is basically 1, which is what we see here. Okay. So portfolio value increase due to stock. And remember, buy and hold strategy, you do nothing, right? So remember, your stock price increase, your risk of portfolio is going to increase a lot. So it works well, with maybe investor risk tolerance will increase with stock price increase. So the investors' risk tolerance increase as the stock price increase. If there's a strong bull or bear market, the buy and hold strategy is pretty good. Bull market, obviously, the investor would have a profit. By the bear market, because of your holdings of risk-free asset, your portfolio would not go to zero. You'll go to the amount of risk-free asset that you hold. Okay. Any questions regarding this buy and hold strategy before we move on to the next one, the next strategy? Everyone's surviving. Everyone's good. Yeah, thanks for reply. Yeah, okay. At least one person is still alive. Okay, good. All right, so let's go to the second strategy now, a constant mix strategy. So what is this constant mix? So instead of a buy and hold, you want to maintain a percentage of investment in certain stock. Support package. What do you mean support package? So, okay, so for constant mix strategy, we want to maintain a strategic allocation in certain stock. And the rebalancing will rebalance it to the initial weight or initial percentage of each stock, right? But what's the main thing about this strategy? Can be summarized by this line, and it's the most important line, I think, to understand this strategy. So you buy low and you sell high. Okay. So this strategy is very good for volatile market, meaning that it's keep on going up and down, up and down. It's a very good strategy. So it's good for investors who want exposure to risky asset but no downside protection. Downside protection means that no, like the past strategy, there is a flaw, right? But this one, might not be so good. I mean, not so good, but there's no protection. So remember, this constant mix strategy, right, is very good for an oscillating market, going up and down, up and down. If it's keep on going up, right, you will have an issue. Okay, why? So this strategy is buy low, sell high. If the price of the asset keep on increasing, this strategy will say you must keep on selling. But remember, when the price keep increasing, right? If you sell at $50, let's say tomorrow increase to $60, you have to sell at $60. When you then the next day it reached $70, you have to sell at $70. Can you see that every time you sell a day earlier, you're losing money, right? Because initially you sell at $50, but 2 days later you can sell at $70. You're actually losing money. So it's really quite bad, this strategy. Well, but let's see why is it good in the oscillating market. Okay. Okay, so before we do that, again, we look at this equation. So this equation says that in this constant mix strategy, your M is less than 0. Your floor value is 0. What does it mean? That means there is no protection at all. Your portfolio can just fluctuate whatever, and there is no protection in terms of floor. When there's no protection in terms of floor, means that the amount of stock that you have would be based on the value of M times your portfolio value. So means the change in stock price will be based on the change in portfolio value, but then the M is less than 1, means that the change in the stock price will be less than the change in the portfolio value. Okay. So what does this mean? So when the portfolio value increase due to stock, remember your portfolio has only stock and risk-free asset, right? So when the portfolio value increase, meaning the stock price increase, you keep selling. You keep on selling your stock and you buy risk-free asset. But like what I say, if you keep on increasing, means that when you sell at $50 compared to $70, you're actually not getting so much money, right? You should actually sell at $70, not $50. But of course, you don't know lah, because you don't know the market trend, right? So if you do this constant mix strategy, it might be quite bad for you. So it works well, with a constant risk aversion, right? So, why I'm going to repeat again, why is it constant mix? It's because remember, when the stock price increase, the percentage of portfolio in stocks will increase. So remember, we're trying to make a constant, your allocation is constant. Meaning what? If your price of stock increase, you must sell more stocks, right? You keep on selling your stocks so that you maintain the equivalent percentage of stocks in your portfolio. So you keep on selling as the stock price increase, okay? So in this sense, you maintain a kind of relatively constant risk aversion by making sure that portfolio values are constant. So in a bull market, the investors will keep on cutting back on stocks because they keep on selling the stocks. In a bear market, it keep on buying more stocks as the stock price decrease. So this is a very big issue as well, right? If let's say the market keep on decreasing non-stop for like, let's say 2 years, and then you keep on buying stocks, but as you buy, right, when you buy at the start of $50, but let's say tomorrow it decreased to $40, you are actually buying, when you buy at $50, it was so expensive compared to $40. But of course, you don't know that, but if you have known that, right, this constant mix strategy is terrible for you if the market is trending in one direction. All right. So this is an important part. It's a concave investment strategy where when the stock price increase, you keep on selling your stocks. So then the increase in your portfolio value would kind of concave, mean like become flatter, right? Because remember, when stock price increase, your portfolio value increase. But imagine you are selling your stock as well. When you sell your stock, that means your portfolio value, the increment of portfolio value becomes more and more flat, right? It becomes like a concave. So that's why it's a concave strategy. Now, then why would people do a constant mix strategy? So a constant mix strategy, right, is very good when the market is oscillating. So for example, what does oscillating mean? So for example, the market goes up, all right? Remember, when you go up, you sell, right? When you sell, you're supposed to sell a stock. Now, because the market is oscillating, when the market go down, you're going to buy. So can you see, you are going to buy low, sell high, buy low, sell high. So if the market is oscillating, this is a very good strategy. So it's called a contrarian strategy, means you are going against the market. So this is what I'm trying to say here. Can you see that the value of your portfolio hit zero, right? There is no protection for you. Remember, your buy and hold strategy had a protection here. Now, this one has no protection. And why is it concave? I'm going to repeat again, is that because as the stock price increase, you're selling away your stocks in your portfolio. And because you're selling your stocks away in your portfolio, the increase in value of your portfolio is going to taper, or it's going to become flat because there's less and less stock, right? Remember, your portfolio has only two things, stock and risk-free assets. So it's going to just taper, like what's seen here. It's just going to like flatten out, right? Sorry, I think this is a repeated slide. Okay, sorry. Okay, yeah. So for constant mix, any questions regarding what is the meaning of this or how does it work? The idea of a constant mix strategy? We are good? Okay. Okay, then let's talk about the last strategy. We call it the CPPI strategy, or constant proportion portfolio insurance strategy. Okay, so the value of risky asset is the multiple of the cushion on the investors, the cushion the investor is willing to risk. So the floor is the lowest value to which the investor is willing to tolerate. So there is a floor now, all right, but is there's some called risk-free asset that has been placed as a floor, right? So it's almost like combining the first and second strategy, right? So there's a floor, which is the lowest. At the same time, you are going to what? So the key of this strategy is you're going to sell stocks as they fall and buy stock as they rise. Okay. So this is kind of the opposite of the constant mix strategy, remember? So this one now you're going to sell the stock as they fall, right? And buy as they rise. Remember, the constant mix is as the stock rise, you keep on selling, right? Now this one, as the stock rise, you keep on buying. So what does this mean? When the stock rise, keep on buying, it means that M is more than one. What does M more than one means? It means that the change in the stock price will become more and more than the change in the portfolio value. Because it's going to keep on, you keep on going to buy more stocks as the price rise. So it's the value, the change of the portfolio value will be more. You keep on getting more and more. So what happens when the portfolio value increase due to the stock? Because remember, you only have two things. You buy even more stock to fund by selling some cash and cash equivalent, causing the stock weight to go up even more. Now, anyone knows what is the issue with increasing the weight of stocks? Anyone would like to give it a try? What's some issue here of this strategy? Right, thanks for the answer. Yeah, overexposure. That's correct. You're overexposing to the stocks. And basically, yeah, you might exceed the risk willingness of your client, right? Or your risk tolerance of a client if you use this strategy. So you must be very careful when you suggest this strategy because you might actually exceed the risk tolerance. Okay, so yeah, so buy high and sell low. Basically, yeah, that's how we're going to. That's just a summary of like this strategy, right? So it's conducive for investors with zero risk tolerance for risk if it falls to the floor. Meaning what? If the portfolio value drops all the way to the floor, because the floor is not zero here, it's the floor, then you don't want to buy any more stock, risky stocks. So zero risk tolerance. But the risk tolerance increase as your stock price increase. So you keep on buying more stocks when the price increase. So your tolerance changes with the market. So market increase as the market is getting better and better, you want to buy more stocks. So for example, like the market now is improving, right, recovering. So you might actually buy more and more stocks now because if you're using strategy, you buy more and more stocks and your risk appetite increase. So you outperform your market with strong and stable trend. So remember the constant mix strategy, I say it's good for oscillating trends. This is very good for stable trends. So you keep on increasing or keep on decreasing. So it underperform in volatile market. Volatile is the oscillating market where you should use the constant mix strategy. All right. And this is a convex relationship that example purchasing a portfolio of insurance with a protective put. So just now we already talked about protective put. I hope you remember what's a protective put. So protective put payout is like this, right? So there's a protection here that is provided, and you can gain the upwards positive increase, right? The protective put. And we'll see this in the graph actually. Let me just clear this. You'll see in the payout graph, can you see that now your straight line again is your buy and hold strategy, all right? And can you see this dotted line here? Doesn't it look like the payoff of protective put that we talked about earlier? That first of all, why is it protective or protected? It can only fall to this value here. It will not fall to 0, but you gain the upside here. Can you see the upside that you have gained? So actually, it's quite a good strategy, right? If you think that the market is going to trend in a stable upwards fashion or downwards fashion. Okay, so last but not least, we're just going to I just want to highlight to you, this is the summary of the strategy that you should use based on the market trends. So how is this going to be tested? So this is going to be tested in the sense of, again, a case, right? And then you need to be able to identify, okay, the market is rising, falling, or is it oscillating, or is it a flat market, no trend? So this would naturally point to you which strategy to use. So why is there 1, 2, 3, 1, 2, 3, all this? So 1 means the best strategy. So when the market is rising and market is falling, means that there's a trend down or up. Remember, the CPPI strategy is the best. So number 1, so there's a 1 here and 1 here, right? Now, when the market has no trend, means that it's oscillating up and down, the constant mix strategy is the best. And of course, now you realize that if you go and compare it like this, if you are very like sitting on the fence, you don't know what to do, you just use a buy and hold strategy, right? See, it's number 2 all the way for all markets is number 2. But at the end of the day, you being the or the reason why you study portfolio management, right, is that you're going to manage people's fund. If you're going to suggest a buy and hold strategy, right, then no one needs you, right? Who needs a portfolio manager if you're just going to buy and hold? Everyone can do that. You can do it now as well. So as a portfolio manager, you should be suggesting at least a constant mix or CPPI strategy, right? If you're going to suggest a buy and hold strategy, you should be very you should justify your reason very strongly why you want to suggest this, when anyone can do it on their own. They don't need a portfolio manager to do it. All right. Okay, so that's the end of the lecture. Any questions regarding what we have covered today so far? I'll just pause here for a short moment. We are good. Okay, so if we are good, maybe, or if you are still thinking of questions, we'll take again another 7 minutes break. We'll come back in 7 minutes time, and we'll talk about the TMA. So I'd like to discuss the questions of TMA, because I think some of them are quite relevant even for your GBA and how you answer your GBA. Okay, so let's take a quick 7 minutes break, and we'll be back. Of course, feel free to ask any questions in the chat during the break. All right, welcome back. Everyone still alive or still listening? Friday night, so maybe I think we might be able to finish a bit earlier if there's not too many questions regarding the TMA. And can enjoy the Friday night. What's remaining of it. Okay, so what you could do, is to pull out your TMA that you have submitted. Like I mentioned earlier, I think when not everyone was here, is that the results will be released, including the remarks and your paper this weekend. But I'd just like to run through the questions first. And more importantly, because I think maybe some of the concepts that that's being tested here in the TMA might be actually useful for your GBA as well, right? So I'd like to just run through some of them so that it will help you as well. Okay, so let's look at this case. I'll trust that everyone has read it, of course, to do the question. So I'll not go line by line and everything, right? The case is just what was written. Right? So this is a very typical way of asking the question. So in your finals, you should expect something like this as well. Case. The thing is that usually it's very lengthy, so you should have use a highlighter, try to highlight. Or if you're doing online, which I believe so, you just try to use a PDF to highlight and annotate along the way, right? Okay, so I think what you can, of course, unmute yourself or ask any questions if you're unsure about the discussion that we're going to have. Okay, so for the TMA, now for question 1A, part 1 and part 2, I think this part wasn't done too well, simply because this question is very, very tricky. Okay, it's extremely tricky. I think only like less than 5 people got like the full marks for question A. All right. So why is it very tricky? First of all, they ask for pre-tax nominal annual return. Okay. First of all, it's pre-tax and nominal annual return. Okay, nominal, not real. Okay. So first of all, it's before retire. This one more or less pretty all right. Most people could get the answer. Let me just share with you my Excel. So this is my calculations. Let me see, what can I do? Okay. As usual, if any questions, please type in the group chat. Okay, so let's just focus on this portion here first, right? So these are my basically the calculations. There's two methods, method A and method B. Both answers, if you answer them, would be correct. Okay, so for method 1, so method 1, right, is the preferred method. Okay, I'll explain why compared to method 2. So before I go there, right, just have the question paper in front of you so that you can understand how we go about the question. So I won't toggle between both, right? Just have your question paper. Okay, so for method 1, what we are doing first is we are going to do post-tax, but we're going to first convert it to nominal. So remember, how we're going to convert it nominal, we have to do the Fisher equation. Okay, so if you're going to just add the inflation into the rate, right, your answer will be incorrect. You need to use Fisher equation. All right, so then we get the nominal. After that, once we get a nominal, then we pre-tax it. Remember, now we're working backwards, so it's a bit counterintuitive because most of the time we put tax into the rate, right? We put tax in, but now the question was a pre-tax, so we need to reverse the tax out. So because you reverse the tax, of course your return is higher, right? So this is the method for method 1, right? Now for method 2, we first do the tax first. So we pre-tax it, then when we convert it to nominal. All right. So I want to highlight that both answers are correct, or will be marked correct. But the preferred method is this. Why? So what's happening here, right, is that you are going to convert to nominal first, then you add back the tax. And the reason why is that because your tax amount is on the entire sum of your returns. So when we run the tax first, right, then we convert to nominal. What is happening here is that the tax, you're assuming that the tax is only on the real amount, the real annual return amount, instead of the entire amount, which is actually the nominal amount, right? So if we are going to go by the books, like very strictly by the books, then only this answer should be accepted. All right. Anyone has any questions for this? So then you ask me, so when should I use which method? So because these are case study, right? It can be very situational when to implement which strategy. So you really need to read the case very carefully, and therefore it's very tricky. All right. Any questions on this part before we move on to the second part? So I repeat again, if you are just going to add, what's the inflation? I think inflation is 4%. Let me just quickly check. I think it's 4%. Yeah. So if you're just going to add 4% to 3%, 7%, your answer will be wrong, because remember, we cannot use that. We need to use Fisher equation. Okay, very good. All right, so if there are no questions, I'll just go on to the second part of the question. So I'll not toggle back to the paper, but we'll just look at the Excel sheet. So the second part of the question say, after he retires, assume he meets his pre-retirement return requirement. So basically, you want to calculate what is his pre-tax nominal return requirement right after he retires. So one is before and one is after. All right. So now the tricky part about this question, and why is it 12 marks, right, is that first of all, when he retires, he's going to cash in on his stock options, right? He's going to cash in his stock options. So what's going to happen? Anyone can suggest, should you consider tax at the moment he cash in or the moment of calculating his return requirements? Which one should we do? Yeah, okay. So some people already see, if you really analyze it this way, you should be able to see that he should incur tax at the moment he cash in. So again, this is very situational. So you need to read the case carefully. There's no like broad like answer. Oh, you should always use this. Always consider tax first. No, you need to read the question very carefully. So in this sense, you must consider the tax implications first at the cash in process. Okay. So what's happening here is that he's going to cash in at 8 million. So if you look at here, I straight away consider the tax on his stock. All right. But remember, if you are going to consider tax on his stock, you need to consider tax on his estate value as well, right? He's going to cash in on that as well. And because you're going to consider tax, post-tax, right? I mean, after you take into consider tax of his estate value, what is very tricky here is that you need to use this value here. Can you see? You need to use the post-tax nominal return. Now, a lot of people use the pre-tax nominal return, which is this amount here. And this is the like the I don't know. I think it's very the question, it's a bit too tricky, right? Because you're supposed to use post-tax because you need to cash in at that point of time. Yeah, okay. Oh no, yeah. It's very tricky. Yeah, so let's say less than 5 people got full marks for this question. So you need to consider the post-tax. not pre-tax. Because okay, so if you're going to use pre-tax, this 10.09 or 8.8, basically the thing here is the same lah. It's just different initial. What's happening is if you're going to use pre-tax, then and you add them up together, then you're going to have an issue. You're going to add pre-tax with post-tax. So it's going to be a very big issue. Then your answers will not be correct. Okay. So you need to use post-tax to calculate his estate value. All right. Then you sum it up together. All right. Then you just sum these two up together. So these are the same. It's just that the values are different. Okay. But I'm just going to focus on this portion here. Right. No, okay, for he's not going to realize investment on inheritance. Actually, he is, right? He's going to realize, okay, it might not be explicitly stated that he's not going to realize it, but then, first of all, they say he's renting an apartment, he does not own any property. So there is reasonable sense to believe that he's going to realize he's going to retire, right? So he needs to realize the value of their inheritance in order for him to survive in the future, right? In order to calculate what is his required returns, right? Because I think it was also mentioned that he does not have any kids and stuff, so he's not going to inherit the estate further. He's not going to transfer the estate, right? There's no further passing down of the estate. So it should be sold, right? Okay, since we are looking for pre-tax nominal return, the figures we can't use. Okay, so there is very good question. There is a few people that did this concept where since you're doing pre-tax, right? You just everything pre-tax it. So we don't even care about tax at all, right? You just use pre-tax figure all the way. Okay. That initially when I was thinking about it, I was also thinking about it quite long. I was like, I initially thought of using this method, right? The simplest way, just pre-tax everything. But what's the issue here? The issue here, right, is that you're assuming there's no tax at all, no tax implication at all when he sells the asset, when he sells the asset. But remember just now we already say that, yeah, at the moment he cashed in, there should be tax implication. So that's why you need to consider the point where he sold his investments and the tax there, work with the post-tax amount, then after that you pre-tax the entire return. Okay, so what I'm going to explain here now, right? Okay, so let's look at, before we go there, let's look at this annual spending first. So the annual spending, we need to consider the inflation and the tax. So this is the annual post-tax real spending, real amount. Because we consider inflation here. Okay. Now, what happens is that with this amount and this amount, we can calculate what is the real post-tax annual return. So we just take this, divide by this, we get real post-tax. Now, remember the concept is that I told you the proper way when we read this question is we should convert to nominal, then we remove the tax. So what I'm doing here is I convert it to nominal using a Fisher equation, then I remove the tax. So I pre-tax it at the end. So there's actually two part that's happening. So you need to post-tax everything because at the point of his retirement, he's going to sell everything and those will be taxed, right? So that's your post-tax and you settle that already. And then you have your annual kind of spending requirements, and these are real because you consider inflation and of course tax as well. So you need to post-tax everything. So basically you need to have everything post-tax. After that, then you calculate what's the real nominal use Fisher equation. I hope that's not an issue. Then you pre-tax everything. So you work with post and then after that you pre-tax everything. So if you are going to work with pre-tax everything from the start, right, that means you don't consider tax here and here. What's happening is that you are underestimating the tax, because the tax actually happened here, and then you want to consider the before tax amount here. So you need to consider tax twice. Okay, I'm just going to pause here. Any questions? So why I think this is important, because even in your final exam, right, you need to be very careful when you read the case. Yeah, it's very confusing. Yes. So you need to be very careful. Like when you calculate this, right, annual post-tax spending, this is a real amount, right? So when you take this divided by this, is the real post-tax. Yeah. And then after that, you convert to nominal, and then you convert back to pre-tax. Personally, I feel that this question is unnecessarily complex because they force you to calculate pre-tax and nominal. So it's like you need to really convert here and there, right? It's like really just playing with the numbers. Okay, so then you're asking whether you can do this, right? Is it you do nominal first? So the end. You pre-tax first. At the end here, right? So if you for here, right? So you're saying, okay, you want to do pre-tax, then you do nominal, right? Yes. Okay. So if you do that, that's fine. For this question, so I think I gave the full marks as well. But the actual method, right, is that you should do the nominal first, then you do the pre-tax. I'll repeat again why. Because you need to convert to nominal, then you tax the entire amount. If you convert to pre-tax first, then you make it nominal, what you're assuming is that a certain, because nominal is usually larger, right? The return is larger. So you're assuming that a certain portion of that nominal amount will not be taxed. So it's a very subtle thing, right? And you see actually playing out here as well, right? So can you see that the final amount is actually arguably a bit different? But why is it different? Is because when you do your pre-tax first before nominal, what's happening is that a certain proportion of your nominal will not be taxed. So in the lecture slides, both I have mentioned both methods. So yeah, whichever method you use will be fine. But in this example, if you're going to be very technical about it, then this method should be the right one. Okay. Any questions before we move on? But anyway, don't worry too much about the TMA. I think most people did very well. Yeah, quite well, because this is the only question that is a bit difficult. The rest, if you kind of follow the lectures and everything, it should be fine. Yeah. Okay, everyone, all right. Okay, so I'm going to move on to part B of the question. Okay, so maybe for part A, right, I think a few students have also emailed me regarding how do you determine whether it is, what kind of cash flow? Was it nominal cash flow, or would you use nominal or real rate, right? So you need to look at the question carefully. For this question, all the cash flows are nominal cash flows, right? There are no real cash flows. So when do you see a real cash flow? The question will state what is a real cash flow. So let me see. I actually have this. Give me one moment. Let me just pull out. So actually, in your financial management course, in year one, I believe the tutor actually went through, or lecturer actually went through this concept, but maybe you might have forgotten. But let me just quickly pull this out since we might have a bit of time. All right, so everyone can see this PowerPoint. So this was actually in your year one. All right. I think I have sent some of your this because you have been asking about questions regarding nominal and real cash flows. So if you can't recall, maybe it might be good to just do a quick recap on this. So I actually copied this slide in your lecture one notes as well. So if you look at lecture one notes, you might see this. So when we are dealing with nominal cash flow, we always use the nominal rate. When we are doing with constant dollar, we use the real rate. So what does this mean? What's constant dollar? So we have this example here on a lease, and we are interested in the real and nominal cash flow. All right. So in this example, this is your annuity. I hope you remember growing annuity, because growing annuity, you cannot, there's no formula for growing annuity. As in, there's no like shortcut. You need to use a formula for growing annuity, right? But this is nominal form. But when you use the real cash flow, you need to convert the returns via Fisher equation, and then you plug into your annuity. Because once you consider real, you don't have to consider the growth factor of your inflation, and hence you can use this formula here, your normal time value of money formula, right? So, so this is an example, real and nominal, right? This is just a quick example. You can look at lecture one. We mentioned this real and nominal quite a bit. Any questions for this? I'm just going to stop sharing. Let's go back to the document. Okay. All right. So if everyone's okay with real and nominal, let's look at part B. So part B, I think the risk horizon and liquidity component, most people are fine with it. Now, one important thing is that this idea of risk tolerance. Okay, so remember when during the first lecture, we have this box thing, all right? And then we say that risk tolerance is made up of or consists of risk, ability and willingness. So it is very important that you need to mention the ability, willingness, and then conclude on the risk tolerance. So if you're unable, if you did not mention ability and willingness, right? How does the time horizon liquidity affect ability, and how it affects willingness? Then you would probably not get the full marks, because risk tolerance is consists of two components: ability and tolerance. Ability and willingness. And remember, we always take the lower of each. So for example, if ability is high but willingness is average, you should take average as the tolerance, right? So tolerance is created by two components. So you need to mention ability and willingness. Everyone's okay with this? So very important, tolerance. Even in your finals, you should put a big star there that if they ever ask you about tolerance again, which is actually very common to ask about tolerance, you need to explicitly mention willingness and ability, right? And how you remember that, you must just remember that box thingy, right? The box. And then you need to mention the, right? This is a very ugly box, but this box here, right? And then we have like ability and willingness and all those. Okay. Okay, for tax and unique circumstances, the thing about tax is that we went quite in depth when we discussed tax, right? We talk about optimization, we talk about some offshore tax structure. So when you discuss about this, you need to mention a bit on how we optimize tax. So saying that, oh, tax might be very high. Okay, that's fine, that's good. But then how do you optimize it, right? Some people mention like loss harvesting. Some people mention about offshore tax structure. That's all fine, right? Now, unique circumstances. If you mention something about like maybe he has no family and need for inheritance, okay, those might be some unique circumstances. You can also mention what is unique is that most of his stock or most of his value of his portfolio, I think one person actually did that. In a sense, they draw out a pie chart of his total asset portfolio, and they mentioned that wait, is it 8,000? Where is it? Yeah, 8,000 is in stocks, right? Okay, it's here. Sorry. Yeah, so 8,000 is in stocks. So if 8,000 is 8 million is in stocks. So when 8 million is in stocks, the issue is that is a lot, right, in stocks, and it's very high risk. So this might be also a unique circumstances. I believe some people also mentioned this, that it is the unique portion. And of course, when we say about unique, it's not enough just to say, oh, this is unique and that's all, right? We need to mention about how we tackle it, right? Okay, so what if a lot is in stocks? If the price of stocks decrease, then our value of the total investment base would decrease a lot, right? So it's very bad. So how do you optimize it? I mean, today we learn about the equity swap. We can do an equity swap. Of course, prior to this, you do not know what's equity swap. So if you mention anything about, maybe he should divest his investments, he should do like more bonds, yeah, those are fine. So these unique circumstances, okay, after today, you know that you can do equity, default swap. You can do a default swap. If you want, you can do an equity swap also to get a diversified portfolio. So instead of being having a risk on just one company, you maybe do a swap for diversified S&P 500. So that'll be a good answer to it. Or if not, you can just say diversify your holdings, right, to like bonds and let's say real estate and all those. Any questions before I go to question 2? We are good. Okay, so for this part on expected return on the 5 portfolio, I think most people got it 5. You probably just get the marks. It's quite simple. We just do expected return. Now, one thing I want to highlight here is more that you need to consider real and after tax. So you need to consider after tax. So you need to remove the tax component, and you need to consider real. So some people stopped at after tax, so you did not use Fisher equation to convert to real. Again, I'm going to repeat this, probably a very broken record, that to convert to real, you must use Fisher equation. You cannot just add or subtract or whatever the inflation. You should add. If you're from nominal to real, you should add the inflation. You cannot add. You need to use Fisher equation. Okay. So if you do not use Fisher equation, you will definitely not get the mark. So please use Fisher equation. So ideal portfolio for Dennis. So this question, right, basically will be if your part A is maybe a bit here and there off, right, you might conclude differently for part B, but the conclusion is actually not important. It's more of the substantiation. How do you substantiate your conclusion? And the main thing you need to always fall back on, and I think I repeated quite a few times over the various lecture, is that whatever you do, fall back on the requirement of the client. So remember, when you're a portfolio manager, right, you shouldn't be concerned about, oh, this is getting the most return or like the least risk. Okay, least risk may be good for a client, but no, that's not important. Remember, what's important is that you need to follow what your client wants. And if your client wants 3% return, which is that's the case here, let me just scroll up quickly. So he has expressed that he would like a return of after-tax total annual return of 3%. So if you mention that we should get a portfolio that is as close as possible at 3%, you will be get the marks, right? So that's the most important part about being a portfolio manager. You should follow what your client wants. So not about, oh, I want the highest return or I want the lowest risk. Yes, those are important considerations. But the first part is about matching what your client wants. Then later you can talk about diversification, you can talk about risk. This is the lowest risk because there's lower diversification, there's no tax, all the other like details, right? But first of all, what's important is you need to follow what your client wants. All right. Any questions for part 2 or question 2? Okay, so maybe I'll quickly just go through question 3, which is not too difficult. Okay, first of all, one important thing is this: present evidence from the case to support your answer. All right. So basically, I think most of you all did it, but I think a few students didn't use the case to support the answer, right? So they just talk very generally about the violations. So you need to use the case, and this is quite important here. Okay. Regarding the violations, there are 4 violations and 40 marks each. So this question is actually very strict in the sense that if you incorrectly identify, you'll be penalized. So you'll be penalized basically for each violation is 10 marks, right? So you penalize 10 marks. So this question is quite strict in that sense. Or even if there's excess violations and they are wrong, also be penalized. So unfortunately, this question is very strict. It's easy to get a mark, but also a bit like strict, right? So you need to be very careful. So some violations that we can think about is, I think there's the idea of suitability of the recommendation of the portfolio, right? And then I think most people, okay, so I think everyone at least got more than 50% of the mark, 20 marks. Actually, most get 30 marks. Maybe you just lose, you are incorrect, 1 violation. But most of your orders got the full marks because it's quite easy to score. So if you mention about communication, if I think everyone mentioned about the violation of communication with client, you should get a mark. This conflict of interest, you should get the mark as well, because conflict of interest, there is the about the commission, right? The commission, you get higher commission if you recommend certain products. Now, the one that was a bit tricky was the comment. So a lot of people identified that is it Jason, or who is the, let me see, what's the name? So he was incentivized to bring his, sorry, Jill was incentivized by Jason, right? To bring his customer after tendering with his employer. So this one, some people mention about professionalism. But it's not really that, because there is actually a better violation. The violation was more of the responsibility of the supervisor or loyalty. So either one, loyalty or responsibility of supervisor, would be correct. But if you mention about professionalism, that one is not really, it might have a bit of overlap, but the better violation that you should identify is the responsibility. So if you mention about the professionalism, unfortunately not. All right. Okay, so actually that's all I have. If you have any questions, feel free to ask. We do have a bit of time. If not, if you have to run, have a great weekend ahead. And I say there's only 2 more sessions. And yeah, all the best for your GBA. Yeah, you can ask about a GBA. Let me just, we are done already. So let me just pause this.